Finance is undergoing a revolution driven by the ever-evolving power of technology. This podcast is your guide to understanding this exciting and dynamic space. In today's fast-paced world, money is no more managed the traditional way. We'll uncover how technology is fundamentally impacting how we interact with finances, from budgeting to investing. We'll also deep dive into the hottest trends, such as the rise of artificial intelligence in banking, the disruptive potential of blockchain, and the growing importance of sustainable finance. So let's not waste time and unpack it all with EdWatch. The world-renowned strategist Chris Skinner says, fintech is not a threat to traditional banking. It is an opportunity to reinvent it. Let's unravel the digital finance revolution together by asking the simplest questions. To answer our questions, today we have with us Cynthia Harrington. She's an award-winning financial journalist and editor with over 30 years of experience in education, finance, and investing. She's the founder and COO of Studious, an innovative study platform where she focuses on using technology to make learning easier. She's a CFA and CFE, and she regularly coaches and gives financial advice to startups. On top of it, she has been my mentor and is a dear friend. So let us welcome Cynthia Harrington. Hi, Cynthia. How are you?
Hi, Sana. Very well. Thank you. So nice to see you again.
So nice to see you. Thank you very much for joining us. Cynthia, would you like to give us a bit of an introduction about yourself?
Certainly. This subject particularly is of interest to me. I had a 30-year career managing money in the stock market, and experienced many of the technology changes, like derivatives and front running with the digital trading services, but some very beneficial ones as well. I've left finance behind, or traditional finance behind, and have started two technology companies working in actually building the products that serve the innovations. My education, I'm a CFA charter holder, and have also experienced this transition from pure finance or pure investing to technology. Now learning Python is a requirement to become a CFA charter holder. So this is a topic near and dear to my heart, and I've spoken or interviewed several of the leaders in this field as well. So very happy to be talking with you about this today.
So thank you, Cynthia. We're really excited and looking forward to learning from your experiences and expertise. So you talked about Python. I remember when I was working on a project in a financial institution, that was 5 years back. And I realized that, this is the way forward. As a finance professional, we need to learn these things, the new technology. We need to adapt ourselves to be able to, respond to changes that is coming in. So there we keep on hearing these buzzwords these days. Everybody's talking about fintech, digital transformation. I'd like to ask a very fundamental question. What is finance and technology? What does it have to do with it? I mean, what does technology have to do with finance?
That's really a fundamental question and often overlooked because it's important to address it. Eventually, we won't talk about fintech or technology and finance. It's going to be just the same thing. But originally, finance was a pencil and an abacus and a piece of paper. And then we went to the first technology, which were the calculators. And then we went to the next technology, which was spreadsheets. But it's computers doing the work faster and or cheaper than a human in accounting for, facilitating payments of, or calculating transactions that the computer does or software does versus a human. Today, that is the entire backbone of finance. It's how investing happens. It's how corporate accounting happens. It's how banking happens. It's how retail transactions happen. Every aspect, every action in banking, in finance, in investing happens via some technological tool today. We talk, I think, about finance and technology, specifically about the use cases, payments, electronic trading, but it underlays everything in finance.
You rightly started your answer from the fact that we started from pencil and paper, then we moved to computers, and now it's time for us to move from Excel to something else, like you mentioned about Python. So here comes my next question. How do you think technology is changing the way we manage money?
Let me answer that question a little bit with one step back, Sana. It's actually changed what money is. Nobody touches money anymore. So through payments, banking, fraud detection, we touch money through a keyboard or a touch screen on our phone, and we don't have a relationship with physical money. It's all digital. So it's easier for us, and it's fast. Very few people go to a store and hand over money anymore. I mean, even at a fast food place, at Starbucks, you order it on your phone before you go and pay for it through the phone. So, and that's similarly happening across. We don't go to a bank and transact anymore. We don't go to a brokerage firm. Everything is integrated onto a laptop, and we manage it. Money is just a number to us anymore. So it's dramatically changed our relationship with the financial assets.
Yeah, just a few days ago, I was at a college. I was talking about transformation. I told them, I shared the case of WeChat. It started off with a chat platform, and now it's handling everything. And today we see previously called Twitter, X, is evolving to something pretty different now. They started off with subscribers. I mean, it was a chat social network where we could go and post our thoughts. We could share news. Now it's so much more, all right? And you can even earn on Twitter, the X platform. Things are changing pretty drastically. What do you think are the trends some of the trends that you would like to mention as far as finance technology is concerned?
So this integration of everything in one place really happened once we got the cell phone, right? I mean, we had to have the tool before the application could realize. And I think that has now sort of that transformational trend has kind of, we've integrated it into the way we do, the way we live. What I think is next, though, is far bigger than anything we've ever seen. Blockchain and crypto have made a huge impact on financial technology, both in how we account for it with the blockchain, and crypto in a completely digital first currency. But what's coming with generative AI and machine learning applications is going to finance in 5 years won't look anything like what we're doing today. And it's from the bottom to the top to the bottom to the top. It will impact every process. It will impact every job. Generative AI can do the work that we now have floors of human beings doing, audits, even cybersecurity. It has the possibility of detecting fraud more quickly and 24/7. I'm just in the process of moving, trying to move one of our company accounts over to JP Morgan. And we use AI in one of the products. I had to do another 50 questions on my questionnaire on the Know Your Customer, because they needed to know how customers are you going to use AI in the interface because of the risks and because of that really impacts if we do business in China, because China has different rules. So it just, everybody in finance is going to change the way they do business because of generative AI. And I think that technology is really going to transform what we've been talking about, how we think about money, and definitely how the financial institutions recast their products and their processes to both use and take advantage of this and be able to better serve customers. So I think that's and that's going to mean that every company is going to have to retrain they're going to have to rethink all their processes, and they're going to have to retrain all their people. So I think this is going to have more impact than anything else we've been talking about on technology.
Cynthia, you talked about AI, you talked about blockchain. Before I ask you to deep dive into these concepts, I'd like to first ask you how banks are adopting to these changes, to these technological changes. We understand that there are fintechs coming up, digital, fintechs probably taking a lot of space of digital payments. How are banks adopting?
Well, and I think that's where we want to step back and take a little bit more of an historical look at it as well, Sana, because independent fintech companies, right, the innovative fintech companies exist because banks weren't innovating. They weren't, and even the big banks, even the big investment banks, they have cultures that the legacy financial institutions have cultures that are risk averse, that are very oriented toward compliance, not. And so they don't make profits out of taking risks. They make profits out of having money on a customer side versus a lender side. So the whole fintech industry as a startup industry exists because banks weren't innovating on their own and started to take business away. So the way that innovation is happening in the legacy companies is really either through acquiring or partnering with the independent fintech companies. And there's a very high percentage, something like 40% of those partnerships, even because of this cultural difference, even the numbers seem to be as high as 40% of those partnerships never really materialize because the cultures are too different. So they can't really, even finding the technology off, out of their normal structure, it just doesn't work. That being said, there still is a drive in the industry for traditional legacy companies to partner outside because they're looking for help with digital products. They can't innovate internally. They're also, though, looking at hiring and partnering with companies that are coming in, and I see this a lot with the blockchain companies, where they're partnering with external fintech innovators to help with the bank's internal processes. They're partnering with other companies because those companies are geared to move fast. And particularly in the areas of data analytics, using the data that they have, and digital banking is where you see a lot of the external partnerships. But this problem goes the other way as well. You see a lot of the fintech companies, because they did move fast, because they were innovative, that doesn't necessarily always fit with complying with financial, both both legacy processes that work, but also regulations and laws. And for instance, like in the early days, the online lenders got in a lot of trouble because they didn't have processes in place to evaluate the customers that were coming to them. People were borrowing from one and paying off to another, and it was which engendered a new way to do financial fraud that didn't happen at banks because they actually did all of the due diligence that was needed to make a serious loan. So, where banks are stodgy and risk averse, fintech wants to move fast and innovate. Where they have come together, for instance, like you see very few of the neobanks are really just a consumer interface. The assets actually go to a real bank. They partner with a real bank. So you've got customer service features that allow the online relationship, but paired with an institution that's complying with all the banking regulations. And those are the ones that seem to be those two aspects, complying with and doing banking according to law or finance according to law, and better customer service. When you find two institutions that can do that, that's where you find the successful pairing of the two. But that's how banks have adapted. They've kind of thrown in the towel to do it internally, or other finance companies have thrown in the towel to do it internally, and they just partner.
So I completely get what you're saying, Cynthia. The traditional banks have become huge by investing, by being risk averse. And while the fintechs, being innovative, became really popular among the consumers because they're innovative, they're they're high risk takers, they're actually reaching out to customers, giving them more access to credit and everything. So are you suggesting, like you talked about new banks, like the new bank we have in Brazil, are you suggesting that partnership between the traditional banks and the fintechs is the way forward? What should be the bank's key strategy?
I think that's probably a question above my pay grade. But I'd certainly give you I'd certainly give you an opinion. The banking culture has never changed. It was risk averse. It's still risk averse. When they tend to get into risky assets or risky trading, like the high frequency trading and the prop desks in the OOs, they get themselves in trouble. It's a culture that then brings in, they don't know how to evaluate even people who are going to take risky actions. Will it ever happen? I don't know. The two cultures seem to be incompatible in initiating. In fact, very few of them actually are compatible in partnering. So I think that it probably will be the way forward, that they will continue to partner, that will be the way that they will innovate. That being said, I will point to, I think it was just before COVID, I think it was 2019, there was a report that came out that JP Morgan's job listings were 60% technology, for 60% for technology people. Now they might be builders, not innovators. I didn't actually go look at the job descriptions, but as they bring more people in, more technologists into the banking world. I mean, not all fintech is wildly innovative. In fact, I met with somebody just this week who has revolutionized the way new fund managers venture capital fund managers can operate their business. And basically, all he did was he integrated a CRM with a way to like a Carta, where how to manage the equity ownership in the portfolio companies, with the compliance, like the SOC reports that they can do within the same technology. So it's kind of like what you were talking about with WeChat. He just pulled everything together so that when the venture fund accountant sits down, they have one log on. They log on and they see all these services integrated, and some of what it's allowing him is they're also able to look at things where before, if they weren't doing well, they just forget about them. Now they have a way of looking at it, and maybe tinkering a little bit and saying, hey, here's your problem, let's solve this problem so you can get some money out of it, or be visible for an acquisition. So as the banks hire more technologists who become skilled and trained on the process, let's just call it the compliant aspect of finance, will they notice even like this example, kind of process level things, and that creates innovative culture within the banks? Possibly. But it would seem that especially for fast innovation, this trend to partner will probably endure well into our futures.
I mean, I'd like to add something to what you've just said. These banks have become so huge. They have thousands of employees. And as I always keep on mentioning when I talk to people in the banks, that more than 50, despite the fact that banks have been investing so much money in technology, they're hiring more people. Like you mentioned, JP Morgan hired 60%, did that 60% hiring in technology. Especially in the traditional banks, your core staff employees, more than 70% of them are working in operational areas, working in operations, finance, compliance. These are the core functions that are driving traditional banks. So transforming overnight to a digital bank would not be possible. You have to take all the functions together. And like you said, that it might endure for some time. So coming to another question, which we'll touch more onto the concept of AI. So this is an era of ChatGPT. This is an era of Gemini, where all the softwares and technology companies are giving AI-driven support. How do you believe that, how do you see that AI support can help banks? And, or I should put it like how the AI support is evolving for banks.
I think AI is going to change everything. It's going to change how banks communicate, have the customer service with their customers, but it's also going to eliminate lots of auditors. It's going to eliminate lots of the folks that are now processing even, transfers over SWIFT. Eventually, what we'll have in every department, investment decisions, lending decisions, operational, compliance, fraud detection, there'll be a few people who know how to operate the AI processes, and that'll be it. I have a very data heavy company. It's not fintech. It's in a different arena. But I used to have all my data set up on a SQL database. And it's still kind of on a SQL database, but I could do much more of it, and all of the interface, all of the reports are done just simply through a little AI request. I just tell it what I want, and I report back that analyzes the data, that calculates the answers, that analyzes the data, that gives me a brief description of the data, and then a graphical report. One person. A lot of the venture funds are now talking about the first solopreneur unicorn. One person creating $1 billion market valuation company. That's on the that's on the innovation side that we've been talking about. But that same set of actions is going to completely transform the legacy institutions as well. Even I mean, we've already gone, and let's just talk about auditing and the accounting business. We've already gone, even with the software changes that have come, where if you're going to go in the old days, go in and audit a Fortune 500 company, the auditors would take over an entire floor in that company's building to do their annual audit. Now they come in and they occupy a couple of conference rooms and a couple offices. With AI, you might just send in one, and you've got the entire audit of a Fortune 500 company. So this transformation from lots of people, even today, lots of people using technology, each kind of on their own desktop, laptop, doing one part of the function. AI is going to do all of that. And so the number of the skill transfer, everybody, I love this phrase about AI isn't going to take your job. Somebody that knows how to use AI is going to take your job.
Yeah.
And I think that's really, I think it's going to transform the numbers of people and the kinds of jobs that they do. But across banking, across investing, across everything, every financial institution that we have is going to be transformed from top to bottom.
Absolutely agree. Cynthia, AI is not just transforming finance function, it's also transforming how the audit is done. So now I'd like to ask you another concept that you talked about in your previous answer. You talked about blockchain. I'll ask a very basic question. What is blockchain and how does it work for finance, for banks especially?
So blockchain is a method of recording transactions. One of the most illustrative, and in finance it can get kind of arcane talking about how that happens. But I was on a panel once with people from Cargill, which is this massive global food producer, and a lot of companies are trying to figure out what to do with blockchain. Right now it's slow and it's expensive. The benefits of knowing every step of a transaction and ownership each step of the way, and the security of it haven't yet created adoption en masse. But this example, I think helps people who don't know anything about it, helps them really like visualize. The first project that Cargill did with blockchain. So in the United States, we have a big day in November called Thanksgiving. And a big part of Thanksgiving is the turkey. So Cargill owns, I think it's Butterball Turkeys. So they own this butter company called Butterball Turkeys. And they wanted to try, they're trying to figure out where do we find use cases that we can test out blockchain? So what they decided to do was they put a QR code, and Butterball turkeys come with a plastic wrapper on the outside. And when you went to the store, you could point your phone at it and it would tell you everything about that turkey, from the people that grew it and who they were and when it was born and how long it was there. And then every step of the way, in every truck that it was in, including the temperature of the truck. Because this is so, and what blockchain does is when you have this set up from beginning to end, each step of the way, there is a block of data, which is the block in the chain, but there's a block of data created with all this data in it. If we were doing something like that and there are applications where you own stocks, where a sequence of ownership of stocks is on the blockchain, every ownership would be written in that same way and then chained with the next owner. That's slow. We already have ways of recording all of this stuff already. The uses that are there are not as good as, but quite sufficient for the purposes. So it's had a slow adoption. In the crypto world, it's needed. It's the only way. It's the only place. These blocks in the chain are the only place that the crypto exists. NFTs. The block in the chain is the only place that these digital assets actually exist. So it's critical. Finding these other applications has taken more time to actually get it integrated into areas where it makes a dramatic improvement on the functions that are already there.
So, Cynthia, my next question is about banks' security, which is very, very, very critical, because banks are the custodian of our assets. How are banks dealing with cyber threats?
Son, that is such an interesting question, and because as technology increases, and there's no more. It's not like stealing somebody's wallet, right? The cyber aspect of it is you're actually accessing all the money. But when the discussions are about cyber threats, it's often about stealing customer data, and that's across it, from insurers, from Experian, which is the big credit rating agency, which should be highly secure. You very rarely hear about stealing the actual money, the actual financial asset, except through blockchain, which is supposed to be secure, right? That's supposed to be the most secure, the hardest to get at. But I actually, we talked about this earlier, and I actually did some research on what were the causes, where are the leaks, where are the breaks in the system. And I was surprised to find out great majority, like 90%, are because of the human in the connection. It's phishing, i.e., or social engineering, i.e., sending an email to a human with the malware, problem embedded in it, and the human opens it and takes action. And so it's not the actual technology that is the weak link. You can probably program AI or program the technology to not do that, where you can't, humans can be fooled. But I also took a look at one of the biggest, and movies are made about sort of big international syndicates getting into the global payment system, the SWIFT system, and yet it really doesn't happen that often. There was a really interesting example it's a little while ago now, 2016, with Bank of Bangladesh, and a group wanted to. You remember it? They wanted to get to basically spoof the U.S. Federal Reserve through the SWIFT payment system, because they were looking for $1 billion. They sent 35 transactions. 5 of them were accepted and taken action on. So they actually wired out about 100 million, and all but 20 million of it was recovered, because they used technology to trace where it went and recovered the funds. So the actual transfer of financial assets, digital financial assets, kind of traceable. It's, it doesn't go off into the ether like stealing a wallet with cash in it. It's just gone. You've got no, I mean, it's not, we call it paper trail, but it's actually, you've got no digital trail. But the stealing of data, customer data, including bank accounts and so on, that can then be used for cyber fraud, is actually a bigger risk for financial institutions than the risk of actually losing your financial in the large, yeah. And then you get down to sort of an individual one-by-one identity fraud, right? That's where the stealing of the customer data is a problem. But it's digital money and digital processing is actually safer than paper money because of this because of the digital trail. So technology kind of solves the problem rather than creates another one in terms of cybersecurity with financial assets.
So, Cynthia, that's where security awareness is, critically important. Banks need to actually train their staff to first know how to deal with, you could say cyber attacks, malware, phishing emails that they receive. The second important thing is that they need to, tell them that what are the consequences of fraud that they may do, or if they try to, like you talked about the identity frauds, because in most of these cases, mostly the employees of the banks are involved. So that is one aspect that could be covered with proper training. A. B, maybe banks need to do a bit more checking or verification when they hire any employee.
There is another point on that as well. And even in the Bank of Bangladesh, they suspect there was insider help. They suspect that the whole thing happened not because of an external threat, but because of inside help. So both of those, right? Character of employees plus how smart they are about opening phishing emails.
My next question is about open banking. How would you explain what open banking is?
Open banking it's kind of a misnomer. It's what we were talking about earlier. Open banking is really just a kind of a consumer interface. Legacy banks are not consumer oriented, right? They make it hard for people to do business with them. You have to go to a branch, or you have to, go through all this paperwork and open an account. I have a friend who has a very successful fintech business in Los Angeles. She worked at one of the very big fund managers, and her job was to open we have a tax deferred savings account that can be used for college. So you open them when your child is basically born. And the paperwork to open that at this big fund manager was like, typical, pages and pages and pages of forms to open up. So she said, I think there's a better way. So she actually created an app. And within 2 years, she had 300,000 parents open these. And then the app to open the account, but then also the automatic saving. She set it up to debit their account. Just hugely successful. Nothing new under the sun, except made it easy for the financial transaction and the accounting to happen. And then reporting, that parents could also look at their balances on their phone. So the open bank is that interface that makes traditional banking consumer friendly. In most of them, though, certainly in her case, and most of the, I think SoFi might have their own bank now, but all of the new banks It's just the consumer interface. The financial assets are actually go to a traditional chartered licensed bank with all of the compliance and cybersecurity and everything that is required by law, which makes them risk averse. The open banking is consumer friendly. The kind of the leader in this is something called Plaid, and even Plaid isn't the consumer interface. There's a lot of banks that use, or a lot of entities that use Plaid. In fact, if you wanted to start a new online consumer financial app today, you'd probably use Plaid, because what Plaid does is it integrates, when you first sign on as the consumer, you first sign on, it says what accounts do you want to see, and you actually give it access to your bank accounts. And then, just like we were talking about earlier with the one log on with the VC accounting, the consumer gets up on Saturday morning to look at their finances, and there's one log on, and all the bank accounts are there. The graphs, the assets are aggregated. That kind of ease for the consumer, traditional banks just have not stepped up to. So the open banking concept is probably what is going to grow in terms of number of consumer accounts, because it fulfills the need for easy access, for intelligent access. Sometimes it's some of the open banking says, here's what you spent on X last week or last year across all of your accounts. I believe what you were talking about earlier with WeChat. WeChat is considered like an open bank, and that integrates everything, right? That's financial services, shopping, probably to-do list. I mean, everything in one. So integrated life, not just integrated financials.
So, Cynthia, you've actually shared some very classic examples of how fintechs are evolved. You find out a very tedious process, and then you realize that you can make it much simpler and easier for people to access funds, to access bank accounts, to access credit, and then you create a fintech. So coming back to the point of inclusion, can digital payments help in inclusion? And if so, what are the challenges?
Well, that's one of the areas that is so exciting about this. And in some countries, we're kind of like the US, this isn't as visible, but where and an area where innovation is being driven by in areas where there weren't banking services, most of the continent of Africa, and so the rest of the banking system, the rest of the world financial system is actually learning from the applications that are being created there. There is not there aren't banking services, and there's not a great internet connection in the continent of Africa. And so people were banking, the unbanked became involved with financial services through digital applications on their phones. And when you've got the ability now, and part of this is also credit, right? Credit grows an economy, but also just facilitating payments grows an economy. One of the examples that I saw is if a mother wanted to send money to their child who's in college to buy books, before you had to put that money in this is an example from Africa. You had to, before the child left for college, put that money in an envelope, make sure that they had it, and now it just facilitates payments. That everybody has a cell phone, and everybody then has access to these to banking today through these applications. And I mentioned earlier that the aspect of the credit, though, is also very important. And there's, again, a company in California called Tala, T-A-L-A. And Tala has grown again, it's one of these that has exploded, and they make loans from $5 to $100. They have a very high loan repayment, and they're making it, again, this isn't in the US, it's the global reach, but they're creating, the people that are borrowing this money are creating businesses. They're not borrowing it to buy a new car. They're creating a business, and out of that business, the capital is what's used to repay the loan, but also improve health, wealth of families. And so this is making a huge impact. Not only is the money completely digital, sent to the phone of the borrower, but the borrower then can pay for goods and services again through their app, can repay it through the app, and everybody has a cell phone. So this could not happen without the banking background or the money transfer background that was developed. But Tala is also very interesting. They do, in terms of applying technology, and kind of back to your reference to technology, bleeds over into all of our lives. So traditional lending goes through something called your FICO score, which is based on your past payments and your how much debt you have, and it's very much into financial statements, personal financial statements. Tala does a credit score looking at people's Facebook profiles. I don't know their algorithm, but based on their repayment,
that's quite interesting.
They figured it out.
Okay.
It's so interesting.
Sorry to interrupt. My credit score is going to be 0 then, because I hardly used Facebook.
Yeah. Well, and me either. That's why I found this. I found this so interesting, and I'm very circumscribed about what I put on there. But they're lending to people that don't have financial statements, that don't have credit cards, that don't have any other kind of financial trail. So they figured out, who are your friends? How do you interact with them? How much attention do you pay for the family? I mean, all of these things, because they're looking for probably a character score rather than a credit score. Are you going to pay this back? So I find them very fascinating because they've innovated on so many of the fronts that are needed in order to make something like that financially, their company financially successful. Technology allows inclusion in a way that you just can't have without it. Yeah, the challenges with inclusion are really around, and this is one of the things that Tala does as well. It's really around education, right? It's really around when you give people money, they need to know how to handle it. But this is also across the board with the consumer interfaces, with the open banking. One of the things that I've been around the financial literacy world for quite a while, and one of the things that has come to light, despite years and years and years and years and years and years of education, we really weren't moving the needle much in terms of the numbers of people that were financially literate. But one thing that does is when you deliver the financial education at the time they're making the financial decision. In the old days, that was only when somebody got in trouble with and didn't repay loans. They went to something like a credit counseling entity, and that gave them knowledge about how not to get in this problem again. Now, with open banking, like SoFi and Betterment are delivering the financial education at the time of the financial decision. So spending decisions, lending decisions, everything is happening through this one entity. So the education can be, it is just, and because of technology, we know the decision is about to be made because you're doing searches or loan applications. And so the knowledge is delivered at the same time. The technology brings a solution to that challenge, but the challenge really is, in the early days, these microloans didn't do so well. like 10% of them
right.
paid back rather than 95% of them paid back. Now, the one change they made was they started lending to women, mothers who really wanted to use the money to help their kids. And that improved it a lot. But the other part of it is delivering this education. So we've gotten in terrible troubles with Robinhood and some of the robo advisors because it fed the speed of the transaction, and the transaction being free fed a trading culture that actually took away from good financial decisions, took away from good investing decisions. So there's still challenges of companies that just want to make the money off it. But because technology, if you're going to give people access to money, if you're going to give people access to trading, they can lose a lot more money faster. And so that's, I think, the biggest challenge is just this education or governance. Let's call it a governance piece of when people are going off in the wrong direction, that there's some guardrails that you can put in, not legal. They're not doing things that are illegal, but they're just not doing things that are smart in terms of managing the money. And the losses happen much faster because of technology.
I think you've rightly covered the importance of financial literacy. And I personally believe that I don't know what has been the course of action by especially the government when they see the evolution of fintech, and there has been so much there's been so much talk about improving financial literacy among people. I personally believe that financial literacy should be or you can say that financial education should be given to people, to kids, even from a very young age. Kids should learn how to manage their money. They get small pocket monies. They get, like in our culture, we are Muslims, so there is this festival of Eid when kids get these Eid. They get some, you could say, pocket money as a gift. So I think from a very young age, kids should be taught how to manage your money. Would you like to shed some light on, how these have been, tackled across the world, as you might have experienced it?
So I actually created and taught a course in a community center in Los Angeles, where most of the community around there were first generation immigrants, or the kids were second generation, but their parents had come to the United States. And by the time that we were done with that course, these kids did and they were middle school, so like 9 to 12 years of age. And by the time we got done with, and it was just a 6-hour course over six weeks. By the time we got done with that course, those kids put together a very sophisticated household budget for themselves. And I mean, actually a real household budget. So it would have been them and their parents kind of perspective. So, but I think the difference, financial education is very boring. Not to those of us that are in the business. We like numbers and and so on. And it's all around, don't do this. Budgeting is all about not spending and saving, and it kind of has this, which again, to those of us in the financial business, it's all created by people in the financial business, and this is how we have financial success. But for the world at large, it feels punitive and just, and numbers just aren't exciting, and math is not exciting to most people. So I think it has to live, it has to come alive for people. Here's a framework around how to make that decision. I'm buying a new car. Here's a framework around how to think about how much to spend, how to get your loan, what kind of insurance do you need? And I mean, because all of these kids, when I first got there, they wanted an Escalade, and I didn't even know. And it's this huge, at this point, probably $120,000 car. And these are kids living, well below the poverty line. And that's what being rich meant to them, was having this Escalade. But the gap between what they thought they wanted and what they were going to be able to do was too great. And a little bit of discussion and knowledge about, why do you want a car? What is it going to do for you? Kind of back to the WeChat. It's finance integrated into life. And so there isn't this kind of separation. It's more about how do you live rather than how do you save. And but to be honest, we haven't cracked the code yet. I think companies like SoFi and Betterment are getting much closer to it, where it's finance that lives every day, and it lives alongside knowledge of the user's bank account, real financial assets. So I think we're getting closer.
Thank you for sharing your experience. So now, what role does technology play in facilitating peer-to-peer lending and crowdfunding? You talked about, access to credit and why fintechs are flourishing, because they are giving access to the consumers that the traditional banks were not serving previously. So how do you see that technology is helping in lending and crowdfunding?
Well, peer-to-peer lending has been going on for all of time, but accounting for it and getting paid back is something new that's happening with technology. And connection, peer-to-peer lending, until technology, you had to know somebody. It was all just friends and family, and it's still a lot of peer-to-peer lending is friends and family. You're still borrowing from, paying back to somebody that you do know, but not necessarily. Crowdfunding is something that is super interesting. And I actually worked at an equity crowdfunding company for a while. I was helping a equity crowdfunding company that did the marketing, with helping them with their companies to look at the financials, at the financials, and how that integrated with the marketing. But crowdfunding that is not equity crowdfunding, so product crowdfunding, it kind of springboards off the peer-to-peer lending, right? You could do crowdfunding before you could, because you'd say, I've got this idea, I want to start this company, or I've got this product, I want to bring it to market. You could go out and sell a bunch of them, but it facilitates access to strangers in both of these situations. And so it facilitates access to the masses, so you can do more. The equity crowdfunding, after 20 years in professional finance, I thought, oh, that's never going to work. There was always a saw about the individual investors don't have the same access to knowledge, and that the professional investor does. And so equity crowdfunding was going to go out and kind of take money from, probably not as legitimately, from $100 here and $500 there from a great number of people, but several, and probably just as many as IPO'd, several significant products and companies have come to market because of crowdfunding. And the ones that are successful often have a product that the investors are also consumers of. And so they often have a better way to analyze the financial prospects of a new product or a new company than some analysts sitting in an office, without windows, trying to punch the same kind of numbers on their computer. So it has really democratized finance. It's made everybody more financially smart because they they really, it is a direct connection. There's kind of no middleman in either one of these. Both of them are things that are here to stay. They're both the peer-to-peer lending, but also product crowdfunding and equity crowdfunding. And the equity crowdfunding is when you have a large consumer user base. Equity crowdfunding is very effective, both from you market your product and you raise capital to grow the company. And neither of them are possible without technology.
So I basically came across this concept of crowdfunding while I was with an accelerator program. I started reaching out to people, asking about how we can raise money, what are the options, who are the investors we can go to. So I was actually approached by a few companies. Of course, they were arranging crowdfunding, helping you arrange crowdfunding. You have to first get it through your friends and close circle, but they are actually enabling you to do that using technology. So there are quite a few companies that I came across, businesses that I came across who were doing that. And yes, I realized that US has quite strict regulations around crowdfunding, which is interesting to see. And I saw that it was not just businesses which were being funded using crowdfunding. They were, you can even go with a small project that you have, and you can register for crowdfunding over there. So that's an interesting concept. Now here I will ask you another question, being in the business. How does technology empower small businesses?
That is, but it's a very interesting question, Sana, and it kind of goes back to what we've been talking about in terms of democratizing. It allows small businesses to act like large businesses. Startups. Talk about some of these, the open banking. I mean, these are startups with 10 people. They've got hundreds of thousands of customers. The assets are going to a legacy financial institution. But the open bank is actually a small business. Tradition, and those are businesses. I make kind of a distinction between businesses that are going to scale and businesses that just intend to stay small. I've got a quote that I actually have posted on my computer now from Khosla, the venture capitalist in Silicon Valley. It says, "We are not that far away from a solopreneur using AI being a unicorn or worth $1 billion. So AI technology just allows, if you want to scale, you can do it with far fewer people. In a way, AI is going to make all businesses smaller in people, but still larger in revenue. But in the United States, we have a phrase that we call mom and pop businesses that are actually lifestyle businesses. You really just, it's laundromats, and a small accounting, a local accounting firm, a hairdresser, and all of those businesses can equally are cutting out layers of costs. It used to cost a lot to get your accounting done or your bookkeeping done, and not anymore, because you can do so much of it. A non-accountant person can use the technology to facilitate the same kind of output that you needed to pay a very highly paid person before. So same with legal services. I mean, with Rocket Lawyer, which is an app that has, I think it might just be US, but it's the legal documents from every state for anything that you need for a company. So it allows small businesses to do a lot more with less money, but at the same level of professionalism, the same level of output. I started my first company in 2013, 10 years before that. And we were able to start it with about $500,000 and build the technology out of that. But I came in after the cloud. 10 years before that, you needed this enormous capital to start a company because you had to buy computers and you had to buy servers and you had and every single company had to have the hardware and software before they could even start their work. It allows a lot of small businesses to do more with less, but it allows every company to be smaller, and much easier to start companies. Even if you're going to scale, even if you're going to grow big, you can get started and do a lot, really get some traction before you need to bring in a lot of capital.
Yeah. So you can open a company in US sitting in anywhere in the world. You can get your documents signed. We have our instructors throughout the world. We get it signed online. All the documents, they are as valid as physically signed document. And fintechs like Stripe and what do we call that? Like Stripe and others fintechs have made life easier for businesses as well. Now, coming back to the financial literacy part.
I think you made a really interesting point there, though, too, Sana, in that they've made the world flat, right? Businesses everywhere use Stripe exactly the same. Businesses, and because Stripe has done all of the local, has brought all the local laws into it. DocuSign has made every business in the world the same. Same service, same fee, same everything. So it has democratized geographically for companies to get started and do it as well. So
I'll go back to the point of financial literacy we discussed. How do you think are educational technologies being utilized to improve financial literacy?
Well, I think that goes back to the delivery, the financial literacy. One aspect is it's more interactive. I mean, when I ran my course, these kids would make out their budget on a piece of paper. It was still effective. But when you can interact and run scenarios on your phone, the learning goes up as people engage with the topic. But I think the most important thing is just this delivery. It's sort of in manufacturing, what do we call it? Just in time. I think with financial literacy, this just in time. I'm considering this financial decision right now. I'm thinking about a new car. The SoFi or whatever sends me 5 articles on how to think about buying a car. What are the implications? An article about how much it's actually going to cost me. I might pay $15,000 or $60,000 or $100,000 for the car, but including if I finance it, including interest, it's 2 or 3 times that. Same, kind of with credits. If you're buying something on a credit card, when that knowledge is delivered at the point of purchase, or at the time of purchase, at the time of thinking through it, and that only happens with technology. Nobody is, well, a few people that are really interested in finance, but most people are not going to seek that information out they're not going to go to the library and pull out a bunch of books or magazines before they decide to buy a car. But technology can deliver the exact same content. The app knows they're looking for the car. So it's anticipation, and can deliver the information at the same time. So with AI, that's 100% of the people alive today, including kids, have to be reskilled on AI. Everybody needs to be reskilled today to understand what it is. And every single year, every single 6 months, they're going to have to be reskilled because it changes and improves so fast. So, and again, that can only be delivered by technology. We can't afford to send people to workshops, take people out of work and send them to workshops. It's inefficient, and things are just moving too quickly. So our company actually uses AI to do professional technology, professional exam preparation. And in that, when you teach adults, what adults really hate is being taught something they already know. So AI can take out what they already know and just deliver what they need to know. And adults have a much wider range of knowledge before the class begins. Some people know the math part, some people know the social engineering part, and the technology or applying AI allows us to tailor the material to this wide range of previous knowledge. Couldn't do it before. I mean, you could give everybody an assessment on paper, but you couldn't. It slows things down to the point where people get bored. You've got to keep people engaged by delivering the information they need at the time that they need it. So that's and couldn't do it without technology. A human teacher, simply can't do that with a class of even 30 kids. They simply can't do it.
And that's where we talk about customer experience. Now, today's world, unless the service is customized, I mean, it doesn't make any sense for the customer to take it. And that's where the businesses actually differentiate with their competitors. Now, I'll ask you another question. Can you discuss the role of robo-advisors in automating investment management and making wealth decisions for the people?
So robo-advisors, the early ones, and really the one that kind of revolutionized, put the field on the map is something called Wealthfront. And when Wealthfront came in, the financial advisory world was up in arms. I think they got $3 billion in assets within 6 months or something. It was just this enormous inflow of assets. And what Wealthfront did was it simply did portfolio allocation according to something called modern portfolio theory, but it automated all of it. So instead of paying a full percentage point or up to 3 percentage points to a human advisor, it was doing it for 25 basis points, so 0.25%. And then they tacked on some other features, like they would manage the stock options for people in Silicon Valley. So a lot of the assets were, and Wealthfront was a Silicon Valley darling, so a lot of the part of that whole ecosystem. But ultimately, it hit very fast growth, but then leveled out within 5 to 7 years, and they eventually sold because modern portfolio theory, while nicely automated, really doesn't work, and it needed to be more sophisticated in how it allocated assets. That being said, for a great number of people, if you can pay a quarter and even have your money intelligently allocated into the stock market, you don't need any more than that. It's much cheaper than going to a lot of the funds. But the robo advisors, because it was a direct access, when one of the functions that a human financial advisor performs is to keep people from doing things they shouldn't be doing, is to it's not necessarily education, but it's a limit. They help to limit people's natural biases in investing. And when the investor has a direct access, and I kind of go back to the example of Robinhood, where they were getting these, they were pumping up stocks on Reddit, and then people were just buying them on Robinhood, and they were as long as you were in early on the Reddit discussion, you could jump on Robinhood and buy it for buy and sell for no cost. And the people that were in early were making all this money, and then they'd find other people that found out about it through the newspaper or whatever, and they'd sell it to them. And then, of course, it would go down. That sort of direct access didn't do, in the old days, this would be called a pump and dump. So it was actually the SEC would come in and crack down on it. Why they didn't, the SEC hasn't really caught up with, the regulators haven't really caught up with all of this. But it wasn't really investing. It wasn't really a smart allocation of time of following all this stuff, or money. So sometimes the technology gives access in ways that do not turn out to be as productive as they might otherwise have been. So the robo-advisors haven't yet fulfilled the promise. I mean, in small ways they have, but AI could change all that.
So basically, what I've seen is that, yes, you're right, that robo-advisors have not been successful so far. But I think it's mostly because this is, comparatively a newer technology. Maybe because, how technology works, it it feeds on data. It needs more data to evolve, to learn over time. And again, that's how AI has helped. AI has evolved over time. So I think that robo advisors or anything like that, any technology like that, it's going to take some time, but it eventually might work out. So yeah. So that brings us to the end of the podcast. Thank you very much, Cynthia, for your time. I really enjoyed listening to you. I have always enjoyed talking to you. So, Cynthia, would you like to actually give us, end with a message or something like that? Any message for us?
I've enjoyed this as well, Sana. This is great. And kudos to you for doing this. I think that this is a great marketing, thing for you. And I tried to put in a few plugs on the AI education. But I think my final comments really are that we're still talking about these two things as separate. We're still talking about finance and then technology, but in very short order. I really think, now, to be fair, I've been saying this probably for the last 5 or 6 years. We're not there yet, but they're becoming one, that we really there won't be a separation. And I think about these technologists that are working at JP Morgan. The finance culture, not even just in terms of startups, but the finance culture and the finance personality has traditionally been very different than the technology personality. And it's around technologists want to be creative and a little less attention to detail. And finance people are highly conscientious and high attention to detail. But as the two work under the same umbrella, I think you're going to find a combination and an appreciation of the other, to the point that you really are going to see conscientious, detail-oriented finance people doing technological innovation. And that's what it's going to take in order to make that crossover. But I haven't seen it personally. But I think it's got to be underway at companies like JP Morgan, like the big banks, with these massive workforces of technologists. So we're living in very exciting times.
Yeah, we're living in very exciting times. So basically, Cynthia, just to tell you, one of my friend, actually my batchmate, he's again an accountant, a chartered accountant. He is actually He's actually heading the data mining in Meta, doing some project in the data mining field. So this is how he has evolved over time. He actually realized the importance of, combining finance with technology. He obviously got the relevant education, the training, and that's what he's doing. And thank you, Cynthia, for joining us today.